Everyone in this world will be having a goal. The goal can be to become a doctor, to become an actor, entrepreneur, cricketer. The list will go on. But only 5% of people they will achieve their goal. They will succeed in the life. Still 95% of people they will fail. The major reason is they don't plan, they don't execute, they don't wait, they don't have patience to travel their own way. That's the reason they will fail. That's the reason they will not succeed. In the same way, when it comes to investing into stock market, only 5% of investors they will create wealth here. They will achieve the financial freedom. Still 95% of people they will fail here. They will not succeed. They will not achieve the financial freedom. The major reason is they don't plan, they don't execute, they don't have the patience, they don't have a patience to travel their own way. That's the reason they will fail here. Hello friends, this is Vijay and welcome back to my channel. In this video, I'm going to discuss about 5 biggest mistakes which will stop you to achieve the financial freedom, which will stop you to create wealth in stock market. Friends, you can stay till the end because you'll be learning a lot in this video. Let's get started. The first mistake is understand the concept of average return. When we talk about equity market, we always talk about historical return. So historically, Sensex has generated 16% of return over the last 40 years. It doesn't mean that every year Sensex has given us 16% of return. Many people they don't understand it. Over the last 40 years, there have been a many correction in Sensex. During the Harshad Mehta scam, Sensex has corrected 40% of correction. Later, it recovered. So during the 2000 in IT boom, Sensex was corrected around 30% of correction. Again, it recovered. During the 2008 in financial crisis, Sensex has corrected 60%. Again, it recovered. During the COVID correction, Sensex has corrected 30% of correction. Again, it recovered. But if you remain invested for a long term, you would have generated average return of 16% of return. That you need to understand. So it doesn't mean that every year Sensex has given us 16% of return. People will misunderstand this. Friends, I would like to give one more example. Franklin India Prima Fund, which is one of the oldest mutual fund scheme in India, over the last 25 years, the fund has generated 20% of return. But it doesn't mean that every year it has given a 20% of return. Friends, now I would like to give the real data. This scheme, which was launched in 1994, in first year, this scheme has generated 79% of return. In next year, it has given a 22% of negative return. Again, fifth year, it has generated 5% of negative return. The after 10th year, it has generated a 24% of return. In 15 year, it has given a 20% of plus return. In 20th year, it has given a 20% of return. So in 29th year, it has given a 20% of return. If you look at the average return in last 20-25 years, it has generated 20% of return. Friends, if you understand the concept of average return, definitely will create a huge wealth in the long term. Friends, when I say average return, it doesn't mean that every year you will get a return. You will get return when you will go through the cycles of ups and downs. The second biggest mistake is don't disrupt the power of compounding. Don't break the power of compounding. Friends, many retail investors they want to enter the equity market during the bull run. They want to exit the equity market during the correction time. Friends, if you do like that, you cannot create wealth in equity market. Friends, I would like to give an example. During the COVID bull run, every retail investors are willing to invest into equity market. They want to enter into the equity market. After the bull run, it's been 2 years now, there is a correction in equity market. In that time, every retail investors, they want to exit from the equity market. Now again there is a bull run. Now everybody want to reinvest. Now they want to come into the equity market. Friends, if you do like that, you cannot create wealth in equity market. You cannot compound your money. That's the reason you should not disrupt the power of compounding. You should not break the power of compounding. The next mistake is don't chase return. Every retail investors, once they enter the equity market, they will be having one expectation. They want to generate multi-bagger return. They want to get multi-bagger return with no time. Friends, it doesn't work like that. They always keep on changing the stocks. They always keep on changing the mutual fund schemes. Friends, if you do like that, you cannot create wealth in equity market. During the COVID bull run, IT stocks, chemical stocks, pharma stocks, they are booming a lot. Every retail investors, they want to invest into IT stocks, chemical stocks, pharma stocks. Now the same stocks, they are giving negative return. Now they want to exit from the same sector. Friends, if you do like that, you cannot create wealth. You cannot. The next mistake is don't check your portfolio very frequently. Friends, now everything is available in our smartphone. When you check your portfolio very frequently, if it is showing negative return, it will simply create you unwanted stress. So that's the reason you should not check your portfolio very frequently. The next one is time is the biggest fund manager. Friends, once you invest into the equity market, equity is a long-term asset class. If you want to invest into the equity market, minimum you should invest with a time horizon of 5 years, 10 years, 15 years. Then only you should invest into equity market. Or else don't invest into equity market. That's the reason time is the biggest fund manager. If you invest for long term, then only you can create wealth into the equity market. Friends, if you summarize the point, the first one is understand the concept of average return. The second one is don't break the power of compounding, don't disrupt the power of compounding. The third one is don't chase return. The next one is time is the biggest fund manager. The next one is don't check your portfolio very frequently. Friends, I hope you find this video useful. If you like this video, please to subscribe, please to share it with your community. If you want to learn more about investment, you can explore my online course. Thank you so much.